Here's a fun little game. Go ask your financial advisor if they're a fiduciary. Then watch their face. Because what you're about to witness isn't just an awkward silence. It's a tell. It's the financial equivalent of asking someone if they're single and watching them suddenly become very interested in their shoelaces. Because if they have to think about it, pause, redirect, or suddenly remember they have a meeting, you already have your answer. And that answer should make you a little angry, because here's what most people don't know. In the United States, there is no legal requirement for someone calling themselves a financial advisor to act in your best interest. Read that again. The person managing your retirement savings, your kids' college fund, and your entire financial future is not legally required to prioritize you. They're required to recommend products that are suitable for you. And there is a massive, criminal, borderline insulting difference between those two words. Let's start at the beginning, because this story goes back further than most people realize. For most of the 20th century, the investment industry operated under what was called the suitability standard. The concept was simple. A broker or advisor could recommend any financial product as long as it was technically appropriate for your general situation. Translation: as long as the product isn't completely insane for someone your age with your income level, they could recommend it. Full stop. Didn't matter if there was a better, cheaper option sitting right next to it. Didn't matter if the product they recommended paid them a commission 3 times higher. Suitable was the bar. And suitable is a very low bar. Think about what that actually means in practice. Imagine you walk into a pharmacy with a headache. You ask the pharmacist to recommend something. The pharmacist looks you over, decides you're basically healthy, and recommends a product that costs $40, takes 3 weeks to work, and happens to be made by a company the pharmacy has a financial relationship with. Meanwhile, there's a $4 bottle of ibuprofen on the shelf 3 feet away. Is the $40 product technically going to help your headache? Eventually? Sure. Is it suitable? Under the suitability standard? Absolutely. Is it a conflict of interest wrapped in a professional recommendation? Also, absolutely. That's the suitability standard, and it's been the legal baseline for financial advice in America for decades. Now here's the gut punch. The alternative to the suitability standard is called the fiduciary standard. And under the fiduciary standard, an advisor is legally required to act in your best interest. Not sort of in your interest. Not mostly in your interest. Fully, legally, documentably in your interest. If they recommend a product and a cheaper or better alternative exists, they have to explain why they didn't choose it. They can't hide behind commission structures. They can't steer you into in-house products for a kickback. The fiduciary standard treats you like a client, not a revenue stream. And here's where this gets infuriating. Certified financial planners, registered investment advisors, and fee-only advisors are typically held to the fiduciary standard. But broker-dealers, insurance agents, and the vast majority of people marketing themselves as financial advisors, most of them operate under the suitability standard. And you would never know the difference by looking at their business card. Meet Karen. Karen is 54 years old. She just sold her house, cleared $280,000 in profit, and walks into her local bank branch to ask about investing it for retirement. The branch refers her to their in-house financial advisor, a guy named Chad. Chad has a nice office. He has a certificate on the wall. He has a good handshake. Chad spends 45 minutes asking Karen about her goals, her risk tolerance, her timeline. Karen leaves feeling heard. Karen leaves feeling confident. What Karen doesn't know is that Chad works for the bank's brokerage arm. He is not a fiduciary. He is held to the suitability standard. And the mutual funds Chad recommended to Karen have an average expense ratio of 1.1%. They also come with a 5.75% front-end load, meaning the moment Karen's $280,000 hit those funds, $16,100 evaporated in fees before the money was ever invested. Meanwhile, a nearly identical index fund tracking the same asset class was sitting right there on the market with a 0.03% expense ratio and no load. But Chad didn't recommend that one because Chad's compensation structure doesn't reward recommending the cheap option. And none of this was illegal. Let's talk numbers. Because the numbers are the part that should genuinely make your blood pressure spike. A 1% annual fee difference doesn't sound like much. In year one of a $280,000 portfolio, it's about $2,800. Annoying, but not catastrophic. But compounding doesn't care about your feelings. Over 30 years, assuming a 7% average annual return, the difference between a 0.1% expense ratio and a 1.1% expense ratio on that same $280,000 is approximately $590,000 in lost wealth, over $500,000 gone. Not to market losses, not to bad investments, to fees, to a cost structure that exists because the regulatory system allowed it to. And Karen is not a rare case. The Investment Company Institute estimates that Americans hold over $27 trillion in mutual funds. A large portion of that is sitting in actively managed funds with expense ratios well above what comparable passive options charge. The gap between what investors pay and what they need to pay is not a rounding error. It is the single largest legal wealth transfer happening in the American financial system right now. And it happens one portfolio at a time, hidden inside percentage points, small enough that most people never notice until it's too late. Now, to be fair, this isn't a story about all advisors being villains. There are genuinely good fiduciary advisors out there who earn their fee, build comprehensive plans, and act with real integrity. This is a story about a system that created two legal standards, buried the difference in regulatory jargon, and let an entire industry market itself under the word advisor without clarifying what that word actually guarantees. It's a story about asymmetric information weaponized at scale. And it almost changed. In 2016, the Department of Labor passed something called the Fiduciary Rule, which would have required all advisors handling retirement accounts to meet the fiduciary standard. The financial industry spent over $300 million lobbying against it. $300 million. To stop a rule requiring that the people handling your retirement money act in your interest. And in 2018, the rule was vacated by a federal appeals court. The industry won. What replaced it was a watered-down rule called Regulation Best Interest, which sounds like it fixes the problem but largely doesn't. Under Reg BI, brokers have to act in the customer's best interest, but the definition of best interest is still vague enough to drive a truck full of commission-paying annuities through. So, where does that leave you? Here's what actually matters, practically speaking. First, ask the question directly. Ask any advisor you're working with or considering working with, are you a fiduciary? And are you a fiduciary 100% of the time? Some advisors wear two hats: fiduciary when managing assets, non-fiduciary when selling products. That loophole is real and it's used constantly. Second, understand how they're paid. Fee-only advisors charge you directly. Fee-based advisors charge you and earn commissions. Commission-only advisors earn nothing from you but earn everything from the products they sell you. These are not the same business models, and they do not create the same incentives. Third, check the expense ratios on everything in your portfolio. Log into your brokerage account right now. Pull up every fund. Find the expense ratio. If you're sitting above 0.5% on broad market index exposure, you are paying more than you need to. If you're above 1%, you are funding someone else's retirement. Fourth, look up your advisor on FINRA BrokerCheck or the SEC's Investment Advisor Database. It takes 4 minutes. It will tell you their registration, their complaint history, and whether they have any disciplinary actions. 4 minutes. Most people have never done it. Fifth, if you're working with a bank's in-house advisor, understand the conflict before you walk in the door. They are not independent. They are not required to show you options outside their own product shelf. Here's the uncomfortable truth at the center of all of this. The financial advisory industry has built an extraordinary amount of trust with the general public. The suits, the offices, the jargon, the certificates on the wall. It all projects credibility. And most people assume that the professional sitting across from them with a decade of experience and a laminated credential is legally bound to do right by them. Most people are wrong. and the industry has had very little incentive to correct that assumption. Because here's the final irony. The people who need financial advice the most, the ones who don't have the time or background to evaluate complex products on their own, are also the ones most likely to walk into a suitability standard advisor and never ask the question. While the people with enough financial sophistication to navigate the system independently are the ones who already know how to find fiduciaries and low-cost index funds. The system protects the informed at the expense of the uninformed, which, if you think about it, is pretty much how every other broken financial system in this video series has worked too. So before I go, I want to hear where you land. Do you think, A, this is fine? Advisors deserve to earn commissions, and the market will sort it out. B, the fiduciary standard should be mandatory for anyone calling themselves a financial advisor? Full stop. Or C, the whole thing is already too far gone, and the average person should just buy an index fund and fire their advisor entirely? Drop your take in the comments, because I have a feeling this one is going to be split.